Canadian lenders and mortgage insurers have seriously started thinking about their mortgage bailout plans as people have started falling behind with their mortgage payments. According to statistics, about 4% of Canadians are falling behind their mortgage payments due to Bank of Canada's back-to-back rate increments. Mortgage payments have exponentially increased. According to Bank of Canada, about 50% mortgages in Canada have already hit the trigger point, which means the payments are not even covering the interest portion charged on the mortgages. So now Canadian lenders and Canadian mortgage insurers are working together to carve out a mortgage bailout plan. Because if it doesn't happen, there will be mass mortgage defaults and economy can go into deep recession. Canada's number 2 mortgage insurer Sagen, which used to be Genworth before, has instructed their lender guidelines that people who have variable interest rate mortgages and who are struggling financially can now apply to extend their amortization up to 40 years. According to recent lender updated posted on 17th of November, Sagen has instructed the lenders to reach out to the clients who are struggling financially due to rising interest cost. So in order to avoid the default, they have issued these guidelines to the lenders to reach out to these financially struggling customers and help them to extend their amortization so their monthly payment can be reduced. So the clients who have variable interest rate mortgages and whose housing expense has increased more than 39% can reach out to their lenders and ask for extension to their amortization. If your GDS is exceeding more than 39% and you are having a variable interest rate mortgages, you could be eligible for this program. The GDS is your housing expense to your total income ratio. This can be calculated very easily. There are so many online calculators available. I will include some of the calculators in the description as well. You just have to plug in some numbers and the system will automatically calculate your GDS. Let me be clear. These default mortgage management plans are already in place, but it was available on insurers' discretion because insurers are the guarantors to the lender. But now Sagen has come up with a plan because they have seen a lot of people are struggling financially because of the rising living cost in Canada. The cost of living has increased exponentially in Canada from recent months, but the wages and salaries of the people have not increased to match up the expenses. That is why this could be one of the potential problem, and lenders and insurers well understand this issue. So that is why they are bringing this mortgage relief plans, these kind of mortgage bailout plans to extend the amortization so people can afford their monthly expenses. In order to qualify for the extension of the amortization, you simply need to contact your lender. Your lender will determine your financial situation, and based on that they will offer you an amortization extension. They don't need to get approval from an insurer, as insurer has already issued their own guidelines. Now here is another important point. If you recently got your mortgage within last 12 months, the lender will not ask any income confirmation. They will calculate your GDS based on your previous income. But if it is more than 12 months, the lender may ask the new revised income data to determine the GDS. Now a lot of people will say that this have opened the door for 40-year amortization. But remember, this is a bailout plan Sagen has put on the table for the financially struggling families. 40-year amortization is not available to new mortgages. If you are purchasing a new property, you won't get 40-year amortization as of today. Canada's mortgage insurers have started thinking about extending the amortization because they are the first one who will take the hit, because their risk factor in the market is higher. Most likely it will be followed by Canada's other lenders as well who have given conventional mortgages in the market. They have started talks with the government of Canada to start bringing out some sort of plan to increase the amortization to make the mortgage affordable in Canada. Right now, interest rates have increased so much that it is not even covering the interest portion of the mortgages, and over the period, people have started building up more debt. About 24% of Canadians have said that they have started borrowing more money to meet their household expenses, which could be a worrisome data. The lenders are not doing it for the people, but indeed their interest is at stake, because if the mortgage default starts, lenders will be the first one who will start losing money big time. So that is why they are coordinating with the government to bring some sort of plan to extend the amortization at least for the existing mortgage holders, so that it becomes affordable for the people. But as you know, nothing comes free in Canada. Even this amortization extension is coming at a cost. When you reach out to your lender to increase the amortization, most likely they will increase your interest rate based on current interest rates available in the market. This could be extended cost over the periods. You have to pay higher interest cost, but your monthly payment will be reduced as your amortization is increased. The second negative point I see in this one, as interest rates are continuously increasing, property prices are declining. So if you don't have enough equity in your property, most likely you won't have the refinance options available in the future, as long as you don't have enough equity in your property. So you could be stuck with one of the lender for a longer period of time if you are not able to refinance your property based on your build up equity. There are a lot of people who are holding variable interest rate mortgages, and they feel cheated or misguided either by their mortgage advisors, their financial advisors, their bankers, that they made a wrong decision. But if we go back, when people started choosing variable interest rate mortgages over the fixed rate mortgages, those decisions were based on the information available at that point of time. Even Bank of Canada's governor, the guy who is in charge of the interest rates, indicated directly that interest rates are not going to increase for a longer period of time, looking at the current economic situation. In fact, here is a clip.
Our overriding message to Canadians is that the bank will be there to provide monetary stimulus for an extended period to support the recovery and to return inflation to the 2% target. Interest rates are very low, and they're going to be there for a long time. We recognize that Canadian businesses are facing an unusual amount of uncertainty. And so we have been unusually clear about the future path for interest rates. If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
So the video like this takes a lot of time and lot of research before you can see it. So if you really like the content I create on this channel, please hit the like button, consider subscribing the channel. If you have any questions, you can mention in the comments below, and I'll personally make sure I answer all your concerns. Thank you so much for watching.